Welcome to our 2021 webinar series. LLIS believes that 2021 knowledge is key. Each month, you'll learn key insurance solutions to better your insurance knowledge. Our specialists will review some basics, use case studies to show how LLIS crafted risk management strategies, and answer your insurance-related questions. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them in the questions box. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. Today's presenter is constantly monitoring the insurance and financial services industry to ensure your clients are getting the most up-to-date recommendations. In 2003, he joined LLIS, earned his CFP in 2006, and assumed the reins in 2012 as president and CEO. Here to cover inherited annuities is Mark Maurer.
Thank you, Claudia, and thank you to everybody for tuning in today. This is a webinar really that I put together over the course of the last few weeks working with an advisor, and his client had inherited some annuities. And so really, this was sort of the brainchild of working with an advisor and some different ideas for the client. And I said, you know what, this is a great idea. This is probably going to be really helpful for an awful lot of advisors because we're not necessarily familiar with annuities on a day-to-day basis, and inheriting an annuity is generally has lots of differences and nuances between how you might handle them for clients during the accumulation phase or even the distribution phase. So wanted to talk about what happens when an annuity is inherited and why do we think this is kind of a big deal? Well, partly because there's a lot of money in annuities. And I like this chart. If we look at 2019, 2,218 billions in annuity assets at the year end. Do you know what happens when you have 2,000 billions? You have 2 trillions. So 2.2 trillion with the TR, trillion dollars in annuity assets. That's all either going to be spent down by the people who own them in their lifetimes or passed on to somebody else. Now that's $2.2 trillion. That's a lot of money. Who owns them? Well, the IRI did a study in 2017 of a number of investors and found that almost half of investors in the study either owned an annuity or previously had. So it's $2.2 trillion. And on average, 1 out of 2 people has an annuity. So if you figure that most people have 2 parents, odds are they might inherit an annuity. So A, it's a lot of money. B, I might be switching between A and B and 1 and 2. So go with me on that. A, it's a lot of money. B, about half the people have one. And why is this going to be relevant here in the short term or even the near future? Where is all this money going to? And you've seen this and read about it, the great wealth transfer over the next few decades. Estimating 59 trillion, again with a TR, trillion of wealth is going to be passed down to millennial children and heirs. 2061, it's estimated that that'll happen between now and 2061. So we're right at about the next 40 years. So what is that? $15 trillion every 10 years. That's a lot of money. Gen X, which I am one, might be the primary beneficiary of this, gaining up to 48 trillion. So there's a lot of these trillions that are going to be passed down So it's happening in the near future. There's $2.2 trillion in annuities. Every other person has an annuity. So why are we talking about this? It's because your clients may not have annuities, but their parents might. So parents who have never worked with you, never worked with an advisor, or maybe somebody in the past, but have annuities. But what happens is when the client's parents pass away and the clients get a letter that says they've inherited an annuity, who are they going to call? Not Ghostbusters. They're going to call you because they're going to ask you, this is something financial, it's an annuity. They'd say, my financial advisor would know all about this. They're going to call you. So I want you to know what you need to know. And if nothing else, just remember, I need to call Mark to talk about these things, those things he talked about back in April of 2021. So ready? Everybody ready to learn? Good. So as I was working with this advisor and looking at some options for his clients, it sort of had a familiar ring to it. So the advisor's client's name was Jan. And she has two siblings, a brother and a sister. Sounds familiar, doesn't it? Well, a long time ago, Jan's original parents got divorced. So, and she went with her dad. Well, eventually, Jan's dad met someone and got remarried. And Jan's stepmom had two kids of her own. I could almost sing the song, but I'm not going to. And all of you are very thankful that I'm not going to. Sounds familiar, doesn't it? I watch this show all the time. So here's Jan, the second one under Mr. Brady right there. They get married, okay? So we're gonna fast forward a few years. And everybody's older. Time has been good to some and maybe not so much to some others. But a few years down the road, Jan's dad passes away. And what does he do? Jan's dad leaves all of his assets to Jan's stepmom. They've been married a long time. He feels like he needs to care for her, provide for her, leaves all of the money to the stepmom. Well, unfortunately, this did not go over well with Jan's brother and sister. But ever since that happened, and pretty much for the whole time, I'm getting some good comments about my Brady references. So thank you. I had fun. Claudia didn't have as much fun putting all my slides together when I tried to explain what I wanted to do, but I had fun with it. So Jan has maintained good relationships with the stepmom. Jan's kids call her Mima, and still is good friends with the stepmoms, with her step kids, her step siblings, I guess it is. But unfortunately, Jan's brother and sister with the frowny faces haven't had anything to do with the stepmom ever since that. When dad gave all the money to stepmom, they were not happy and have not really ever talked to stepmom again. And so when Jan's stepmom passed away earlier this year, she left two annuities. She owned two annuities and left them. How did she leave them? Well, guess what? She had three beneficiaries on the annuities. Jan and Cindy and Bobby. Greg and Marcia, who weren't talking to stepmom, not named as beneficiaries on these annuities. So do we really need to go through all this to talk about how to inherit an annuity? Of course not. But this is the kind of detail that you may have to work with your clients the sort of information gathering that we go through to figure out what's going to be the best option. And obviously, sometimes the complications that can come from family dynamics and inheriting money. So I want to talk for a moment about setting up the beneficiaries. And when you have annuities or life insurance, you name beneficiaries. And so in this case, what happened is Mrs. Brady named Jan, Bobby, and Cindy as 3 primary beneficiaries, a third, and a third. And so that's what happened. Because Mrs. Brady died first and the 3 oldest kids were alive, the money was distributed as intended, as set out, so fairly easily. Sometimes there's a complication in that what would have happened if Jan would have died first. So Mrs. Brady never changed the primary beneficiary designations. So it still said a third to Jan, a third to Bobby, and a third to Cindy. Or he might be Peter. I don't remember. He's Peter or Bobby. He's not Greg, I know that much. Maybe he's Peter. Ooh. So if one of the primary beneficiaries passes away, and then Mrs. Brady had passed away, there's 2 types of beneficiary designations that happen. The first one is called per capita. Oh, and under Jan are her 2 kids. So there's 2 kids. Jan has 2 children. If the beneficiaries had been set up as per capita, it passes per head. And so what that means is that at claims time, the insurance company is going to say, there were 3 heads here, but one of them's passed away. So now we're going to pay all of the claims to the 2 heads who survive, 2 remaining. So even though Jan had been named a third, well, 1/3 beneficiary, because she was passed away first, half of it would have gone to Cindy and half of it would have gone to Peter or Bobby, leaving Jan's kids without anything. So that's per capita. It looks at this, the primary beneficiary levels, or this first level, who's alive, we're going to split it evenly between whoever's alive. But then you have another one called per stirpes, which is by blood or sort of a familial line. And so what it would say is that it's going to be a third to Jan or her line, a third to Cindy or her line, a third to Peter or Bobby and his line. So in that case, what would have happened is Jan and Bobby Peter would have gotten their third, and Jan's third would have then been distributed to her 2 daughters, who each would have then gotten 1/6 of the total amount. A lot there, but it's important to make sure beneficiaries are updated, because Mrs. Brady may not have known how it was set up. She may have wanted it to be per stirpes, but because had Jan predeceased her, it may not have been set up that way. So just important to keep beneficiaries up to date. I touched on this. Beneficiaries with an annuity are named like a life insurance contract. So it passes outside of probate. It doesn't get lumped into all the other assets, doesn't get distributed and have to go through the will and all of those things. So it's a very nice way to pass money on to somebody. It also stinks for Greg and Marcia, because there's not a will to contest. They can't say, oh, she forgot us. Now, I imagine you can probably do almost anything when there's inheriting money, and anybody can come into this and claim things. But I would imagine that it's harder to do it when you name beneficiaries than just trying to have it all lumped into a will. There's another important feature about inheriting annuities. there's usually a rider that talks about the death benefit of annuity. There may be a statement or a letter that talks about the death benefit of the annuity. The death benefit of an annuity is not tax-free. With life insurance, it is. With an annuity, it's not. Taxes are deferred in life, but then taxes are payable on death. And so if there's gains in an annuity, when the non-spouse beneficiary inherits it, the gains, there's income tax that has to be paid on those gains. An exception will be an annuity inside of a Roth IRA because it's a Roth IRA wrapper and the tax rules apply to that. You know, at the end of the day, it's likely a good problem to have. You know, if somebody leaves you $250,000, it's probably okay that you pay some taxes on it. It's more than you had the day before. But sometimes it can be complicated, and there's some timing and all sorts of things to help clients with. And so that's what we're going to talk about here, especially some things with some timing. Somebody asked, what happens when the beneficiary of an annuity is a trust? I'm going to talk about some of the distribution options there. It's limited. It's more limited on a trust because there's no life expectancy. It's not an actual person, but taxes are still due on any gains. So good question. I'm going to touch on that later. If I don't answer the exact question you were looking for, let me know. So Jan inherited 2 annuities. I got the letters from the advisor, and one of them was a non-qualified annuity worth $397,000. And the other was a qualified annuity valued at $279,000. So Jan's already, you know, better off by about, you know, $600,000. It's not a bad day. Well, I guess it's probably a bad day because her stepmom died, but financially, it's not a bad day. So the first thing I asked about was this non-qualified annuity. When you have a non-qualified annuity, you fund it with after-tax dollars. So you create a cost basis. So the first thing I asked is, what is the cost basis of the non-qualified annuity? Because the cost basis is going to really tell me how creative I need to be with some of these options. Oh, one question, is Jan's husband considered per stirpes? And he would not be. He is not a blood relative to Jan. So it would be to Jan or Jan's offspring. It does not move to a spouse. Good question. I love the questions. Jan, so the cost basis was $135,000. So it's worth about $400,000. $135,000 is the cost basis, is the after-tax premiums that went in. So that's where we're starting with. Let's talk about the non-qualified one first, because there's a few more options in the non-qualified annuity to go through, and because it really is its own animal. A qualified annuity works much more like an IRA. So if the person inheriting the non-qualified annuity happens to be the spouse, they can continue it on as their own. Just change the ownership, really nothing you need to do. But for a non-spouse beneficiary, there's 3 really times or ways you can take it out, and we're going to talk about a few subsets in those. But you can take a lump sum distribution, you can take distributions over 5 years, or over the inheritors, the beneficiary's lifetime. So 3 primary options there. And so for the question one time about if a trust inherits it, a trust doesn't have a lifetime. So a trust would have to distribute within either the lump sum or 5 years. So simplest one, just going to cash it out, take the lump sum payment. Jan says, yes, let's take the lump sum payment, $397,000. Woohoo. Awesome. Let's go. Okay, $397,000. $135,000 of that is the tax-free cost basis. That passes on to Jan because it was after-tax money. You're not paying tax on after-tax money again. However, because the $262,000 of gains in the annuity were never taxed, annuities allow you to defer those gains, all of those gains are taxed, and they are taxed as ordinary income. There's no cap gains here. And if she just surrendered it, she would get a 1099 this year for $262,000. You know, I guess it's better than a stick in the eye, but maybe we don't want to create a giant taxable event right now. If Jan was retired, maybe just fine, but for many of your clients, may not be ideal. So here's some helpful tips. On any annuity payment or claim form, whether it be the lump sum, whether it be the lifetime, whether it be any of those options, you can ask the insurance company to withhold estimated federal income tax. You can, I think, in most states, you can ask them to withhold estimated state income tax. So while that $662,000 of income sounds pretty scary, you would have the option to withhold 15% of that. And so the check that Jan would get would be much smaller, or not much smaller, but smaller. But knowing that that's already been withheld, and so when she goes to file her taxes, there's not a $20,000 or $30,000 taxable surprise or tax bill due. She's already withheld a good amount of it or a good estimate of it. So just something to know, can do it. So it's not as scary as trying to tell her you need to hold on to $30,000 or $40,000 for next year to pay your taxes. So lump sum, it's nice and easy. It's nice and clean. It's best when there's a large cost basis. Remember, the first thing I want to know was how large is that cost basis? If the annuity was $397,000 and her cost basis was $390,000, I'd just say cash it in. Why? She's going to get a $7,000 1099. She's going to owe tax on $7,000 of gains, and then she can just basically take it all, pay almost no taxes on it, and do whatever you want with it. So don't have to worry about some of these other options. When it's a low cost basis, that's when we need to get sometimes a little bit creative, look at the client situation. We're going to talk about Jan's situation and the annuity size. As my dad has a favorite saying of one of mine, making sure that the juice is worth the squeeze. Because let's say there's a low basis, but the annuity is only worth $10,000. It may have a cost basis of $5,000. Cost basis of $2,000. Proportionally, that's a big gain. But at the end of the day, if you cash in the annuity and you can't buy an old Fiero with it, then maybe it might just be worth to take the $8,000 of gains and move on. Question: did the Secure Act change the distribution rules for annuities? Can still use lifetime distribution? Correct. And I'm going to touch on that. Secure Act changed it for IRAs, but not for non-qualified annuities. So, and that's partly why I wanted to go into non-qualified annuities first. Good questions. So lump sum, it's not ideal in this situation. Well, A, because there's a big tax. There's just a big tax. But Jan also has Dan. Dan has a good salary, but he has been working for a startup company, and he's expecting some stock options to vest and to exercise over the next 5 to 7 years. Yes, not everybody gets all of my Brady or Fiero references, so good stuff. So he's going to have some stock options that vest. So he doesn't know what his income is going to be over the next couple of years. It may be pretty big in any given year. He may not get any in any given year. So they're looking at this saying, I don't know, we could take the lump sum right now, but this might be our biggest income year ever, and we aren't going to know for 6 months. So we don't really want to lock ourselves into that. Income could be high for the next years, it could be low and unpredictable. So maybe something that spreads out the gains is going to be preferable for them. The problem with some of the inherited annuities is usually you have a fairly short period of time to make these decisions. Not super short, but you can't delay it for 2 or 3 years while you figure out what you want to do. So that's our first option, lump sum. Cleanest, this case, big tax. Can take withdrawals over the next 5 years. So she could leave the money with the current annuity provider, exchange it to a different annuity. I'd look at one that has no surrender charges, low fees. So leave it with the current annuity provider or move it to another non-qualified annuity for the next 5 years. If she doesn't do anything, this is what's going to happen. They're just going to say, we're just going to leave you where you are, and you need to take this out within the next 5 years. So that's going to be the default. I think probably a new annuity with lower expenses is going to be better for her, but either way, we're just going to say we leave it in some sort of deferred annuity for the next 5 years. When she takes out her withdrawals, they're taxed LIFO. So all of the gains, as she takes withdrawals from this annuity, all of the gains are going to come out first. And again, ordinary income, no cap gains here. So for fun, we're just going to say she's going to take 5 equal withdrawals over the next 5 years. To make things simple, there's no earnings, there's no gains, there's no losses, just nice and easy, which I think is a hair care product. Nice and easy. She's going to take $79,400 this year. Remember, her gain is 262, so that distribution is 100% taxable. Second year, $79,400, 100% taxable. Someone asked, will it continue to grow for the next 5 years? Like I said, depending on, it could be in a fixed annuity that's going to have a rate of return that grows. Her current one is in a variable annuity, so it could go up, it could go down. So for sake of argument, we're just assuming that it stays stable. Year 3, 100% of that withdrawal is going to be taxable. Year 4, see what happens. She takes another $79,400. $23,800 is taxable. She used up all the gains. Then $55,600 of that is tax-free. When she takes her 5th withdrawal, year 5, 100% tax-free. So you have to take it out over 5 years. It's all the tax first. And this is okay. It's more even. It's not all at once, but the tax is kind of front-loaded. And realistically, when you get to year 4 and you don't have any gains left, there really wouldn't be much reason to not just use it all up then. So probably in the 4th year, you'd take 150 some odd thousand. So one of the issues with doing it this way is when you spread out the taxes, you sort of take lower amounts up front and get the biggest amount at the end. And so that's a little bit of delayed gratification for some people, and as a society, we're not a big fan of that. So that's one option, just a way to distribute it over the next 5 years. A 3B, or number 3, which is sort of a 2B, is instead of leaving it in a deferred annuity and taking withdrawals, we're going to turn it into a 5-year immediate annuity. So it still gets the payments out over the next 5 years. It fixes the value of the annuity. So in this case, it doesn't grow like somebody asked. So that $397 is locked in. So if the market goes up, you may not have been as excited. If the market goes down, you were happy that this locked in. So it's probably very good for someone who's risk averse at this point. No market fluctuations. The cool thing here is that it creates an exclusion ratio. So it spreads the gains out over the 5 years, and it spreads the cost basis out over the 5 years. Now, because annuities do have, immediate annuities do have some interest rate calculations built into them, I ran the numbers, and so the payment's a little bit higher. And so $80,000, but $27,000 of each payment is going to be tax-free, $53,000 is taxable. So instead of 79, 79, 79, 23, none, now we've got 53 taxable every year. So we smoothed the gains out. We spread them out over the 5 years. We made it a little more, again, a little more even, so that any given year, it doesn't hurt quite as much as that lump sum. Better for spreading out the tax. Like I said, we smoothed out the tax. Locks in the current value. It's simple, it's predictable, it's exactly what it's going to be. This is probably a great idea for a project client or non-ongoing clients who just ask for some help here. It's a way to spread out the gains. There's no market volatility. There's nothing to monitor. And you know what? Clients can get into less trouble than with a lump sum. When you have a lump sum, you may do things that you may not do when you just get some regular checks. So 5-year SPIA, as compared to the withdrawals over 5 years, I tend to favor the 5-year SPIA because it spreads out those taxes even more evenly. Number 4, can annuitize it over lifetime. Still an option with non-qualified annuity. It spreads the gains and basis out over the longest period of time. So you see here, $16,000, lots of different options for payments. You can have a life only, so if she dies after 1 year, there's no more payments. You can have a cash refund that says, we'll pay the $16,000 for as long as you live, but if you pass away, we'll make sure that the total amount of payments are $397,000 at a minimum. So, but little north of $16,000. Spreading out over her lifetime. So $3,000 of each annual payment is non-taxed, $12,000 taxable. I think that one's the best for taxes because it creates the smallest amount of tax every year. Spreads the gain, spreads the basis, gonna have a lifetime income. She can't outlive this income stream, so that's always good. My experience, no one takes this option. No matter how good it is for taxes, no matter how good it is that you create this lifetime income stream that you can't outlive, no one's taken this so far. And I think it's because you inherit this money and you think of it as a windfall. And when you think of $397,000, you say, we're gonna buy a mountain cabin. Awesome. If I tell you you're gonna get $80,000 a year for the next 5 years, you say, great. This year, I'm gonna buy a Porsche Panamera. Woohoo! And maybe I'll buy one next year if I want to. $16,000, I can pay my mortgage. Maybe my electric bill too every month. See how unexcited I got when I just related to bills? So just don't think it's that exciting to people. The money is thought of as a windfall, so you think of fun things you'd like to do with it rather than probably the uber responsible things. So nobody really takes that one, even though it's the best way to, I think it's the best way to spread out the gains. Someone asks, are the 5-year immediate annuity and lifetime payout options available for all non-qualified annuities, or does it depend on the contract? Good question, because what I didn't go into here is that in my scenario, so you can have the annuity and there's a claims form, and the annuity, the current annuity is going to say, here's some options you can do. You can do a lifetime income, maybe a lifetime with 10. One of the options is we can also exchange it to another non-qualified annuity. So in my scenario, it doesn't necessarily matter too much what the existing annuity does, because I said, if we want the immediate annuity, we're probably going to exchange it to somebody else who probably has a better immediate annuity rate than the existing company. So we're probably looking at doing the immediate annuity is probably going to be an exchange, a 1035 exchange of the current annuity to somebody else to get those. So great question. Great qualifier question. Number 5, a non-qualified stretch. Now this is getting pretty interesting, but it's kind of fun to look at too. So this would be doing a 1035 exchange into a non-qualified annuity, and it uses the over the life expectancy of the beneficiary language that the IRS wants to do over the lifetime. So it allows you to have income tax control, some flexibility, growth potential, immediate access when we're looking at no surrender charge annuity options. And it's only for an individual beneficiary. Remember, if the beneficiary is a estate or trust, the 5-year rule applies, which the 5-year rule says you must distribute it within 5 years, but because lump sum is within 5 years, that's kind of included in there. So, non-qualified stretch. There is and I can't come up with a better word than required minimum distribution, but anytime I hear that, I think of qualified money. So we're going to call it a minimum stretch distribution. But it's a calculation based on the amount of the annuity and Jan's age, so it's really kind of the same thing that says you must take out at least this much this year. And so for Jan at age 47 on a $397,000 annuity, her stretch distribution is 11.6 this year. So if this is what she does, she must take 11.6 to meet these rules. Now she can always take more, which is good because that's some flexibility, but must take that out this year. And so because there's Jan and Dan, the non-qualified stretch may be a good idea because they can take those minimal taxes, those minimal stretch distributions now, creating small taxes, because right now may have to do something, or it's the end of the year, have to take something out, not sure what the distributions, the stock options are going to be, and so can take small ones. If it's a low stock option year, maybe they take more this year because kids are about to go to college. Once they're retired, or there's no option, maybe when they're retired, maybe they just take the minimums for the next few years, and then once they're retired, they take it all out over 2 or 3 years, create some, get some extra income. So it allows some flexibility, but they still have that minimum they must take every year, but can always take more. All right, so what about the qualified annuity? And you all sort of teed that up for me really well. Because that qualified annuity, it's $279,000, but it's nothing to sneeze at. All right. An annuity inside of an IRA is just that. It's an annuity inside of an IRA wrapper. And so when we see it, and it's still hard for me to think about, but think of an annuity inside of an IRA the same way you would as a mutual fund, cash, stocks, bonds. The IRA wrapper, or a qualified annuity is nothing but an annuity inside of an IRA. It's the IRA wrapper that makes it work. So remember, if you wanted to do some sort of transfer, say you wanted to transfer somebody's IRA from Fidelity to Vanguard, you don't transfer the annuity, you don't transfer the mutual funds, you don't transfer the stocks, the bonds, you cash it in, and then what transfers over? Cash. So a qualified annuity is really just an annuity inside of an IRA, but just think of it as any other asset inside of an IRA. Question, is the inherited non-qualified annuity titled as an inherited annuity? That's a good question. I believe definitely with the stretch, there's a designation there because it has those required minimum distributions. For something like the 5-year immediate annuity, I don't believe there's anything there. Again, with the lifetime, I don't think there's anything there that qualifies it as anything different. Another question, for the non-qualified stretch, is the $11,000 all taxable, or does it have that sort of cost basis and gain distribution. It's a withdrawal, so it'll be all gains first. So the same if it had been 5 years, any withdrawals from the non-qualified stretch are going to be all gains out first, all income out first. All right, then another question. What if you take lump sum and reinvest in stocks to create long-term capital gains with step up? That is a great question. I'm not really qualified to answer that one because I'm not an investment person. So what I can tell you is that if you took the lump sum, you're going to owe tax on all of that. So my thing is to look at what is the best tax strategy there. You may model it that it works better to pay the big tax now and reinvest, and that may be just fine too. So remember, qualified annuity is an annuity inside of an IRA. So if you do any changes, it's really just money going over to another IRA. Why we get confused, and even why I muddle through it sometimes, is that here's the annuity statement. It's got the insurance company, it's got annuities, annuity statement, strategy allocations, It's this one little section right here, right there. It says tax qualification, IRA. Sometimes it'll say qualified. We think of it as an annuity. We think of all the bells and whistles and things that go into annuity, but really it's just an asset inside of an IRA. So the IRA assets, the IRA rules are what take over here. Question, is it safe to assume that all annuities waive surrender charges at death? I would say that is a likely assumption, but I wouldn't say it's an always. But more than likely, yes. Qualified annuity. Qualified annuity, same rules as any other qualified money. You have the lump sum. You can do withdrawals to defer the gain, or you can annuitize. So here, her qualified annuity, $279,000. It's going to take the lump sum payment. What's the cost basis? 0. So she's going to owe ordinary income tax on $279,000 this year if she cashes it in. Question. Pretty sure it's something about step up with any annuity. So that's correct. When you inherit the annuity, there is no step up, whether qualified or non-qualified. So all those gains are charged. I think the question before was, what if you invest if you take the lump sum and then invest those proceeds into a non-taxable account that would then have the step up. So just to not get things confused, when you inherit an annuity death benefits, there is no step up in basis with annuity. So just in case I read a question wrong or wasn't clear, that is correct. There is no step up with any annuity when it's inherited. All right, so qualified annuity, same as inheriting an IRA. Non-spouse inheriting an IRA, take a lump sum payment, $279,000 taxed. Or you can take withdrawals over 10 years. You're thinking, Mark, what? Did I hear you right before? You said, well, it's 5 years. And you are correct that it's 5 years with a non-qualified annuity. So with a non-qualified annuity, you have a 5-year distribution and or lifetime options. Because it's a qualified annuity, the IRA rules win. And so we have a longer 10-year withdrawal option, but we don't have the lifetime options anymore. Because remember, a qualified annuity equals the IRA rules. And so the Secure Act got rid of the stretch IRA that can be over the beneficiary's lifetime. 10-year payout maximum for non-spouses, and there's a few exceptions, so we're not going to go into the few exceptions, I think, for disability and certain things, but for 99% of people, 10-year payout or shorter. And so who do we need to worry about that with? If grandma has a $100,000 IRA, leaves it to her 3 grandkids, this comes back to, is the juice worth the squeeze? If your client inherits $33,000 in an IRA, you could stretch it to $3,000 over 10 years, or take the $33,000 and pay the taxes on it now. I think most people are just going to take $33,000, pay the tax now, rather than look at some of the more complicated options. So again, all of this is coming back to a qualified annuity is the same as an IRA. You almost forget that there's an annuity in it. It's money inside of an IRA. So again, for this client, first, you could probably roll it into an IRA that you can help your clients with. This is a qualified annuity, and this policy might be a Great American was the illustration I looked at before, or Transamerica, or somebody. And so it's it's money inside of a qualified plan. No reason not to just roll it to an IRA, an inherited IRA at Vanguard, wherever you might be able to help the clients with the investments. Because right away we got rid of any annuity fees. Remember, it's money inside of an IRA wrapper. We just moved it into a different IRA wrapper with no annuity expenses, no fees. And now we have unlimited investment options as compared to the choices that are in the annuity, the qualified annuity. Maybe added it to AUM, but it's going to have to still be distributed with over the next 10 years. Here's where we have some flexibility. It doesn't have to be even. As long as it's distributed with the next 10 years, take withdrawals as needed. Flexibility is good for Jan and Dan, but can't go beyond the 10 years. So again, this may not be great for clients who you're not working with on an ongoing basis, because if they just forget to do anything and go, oh, this might be a good big tax year, I'm not going to take money out this year. And if they keep waiting and keep waiting, they have to take it out in year 10. And if that happens to be his biggest income year ever, well, you know what? That didn't work out so well. So nice that there is some flexibility here. I'd probably still think that, to plan on taking something out every year. Or do a 10-year immediate annuity. Again, it's nice and easy, it's simple, it's straightforward, don't have to, really nothing to forget, meets the 10-year requirements, fixed payments, fixed amounts, no investment volatility. We're deferring those gains over the next 10 years evenly. And because the immediate annuity has some earnings to it, over the next 10 years, she'd end up getting $30,000, a little over $30,000 a year for the next 10 years. So nice and even, nice, easy way to look at that. So there's very little gain in that, or very little earnings in the annuity. It's all taxed as gains. That's bad wording there, very little gain. It's all gains, it's all taxed as ordinary income, but didn't earn much from the immediate annuity. That payment isn't a whole lot more than just dividing it by 10, but the benefits are the above. It's fixed, it's settled, we know exactly what it's going to be, and distributes it out over the next 10 years nice and evenly. Question, if the annuity inside the old IRA had fees for cashing it in, will those fees kick in when it gets cashed out and proceeds rolled over to a new IRA? So sort of back to the first question, I'd say more often than not, if there's any surrender charges, those normally get waived at death. So more often than not, there won't be any surrender charges. I'd say probably most of the time. Like I said, I hate to say all the time, because someday there will be one that it didn't, but normally death is going to waive any surrender charges. So there shouldn't be any fee for cashing it in, which you would pay either by surrendering it or rolling it over to a new IRA. So for the most part, I think it's probably worth asking or worth checking a statement to see if there's anything there, but most of the time that's not going to be something we're going to have to worry about. All right, any more questions? I'm just looking to see if there were any that I missed. No, I don't think so at this point. So again, please feel free to ask me any questions. And question, does a conduit trust get treated differently? Able to stretch? That is a great question. I do not know the answer to that. I believe that with the new secure rules, anything that was a trust has to have the 5-year distribution. But I can find out, and Claudia will remind me to see if I can find out that information. Great questions, everyone. So, what are the takeaways today? That's another question. Nope. What are the takeaways today? Oh, another question. Must the 5-year payments for a non-qualified annuity be equal? Again, the answer there is no. I illustrated what I thought were even payments just to go over sort of the tax distribution. They could time it so it would be more flexible for Jan and Dan based on the stock options he's getting. Wouldn't have to be even. There's even one idea I had would be to say, instead of $79,000 every year, just divide the gains by 5. So maybe take $50,000 every year for the first 4 years, and then in the last year she'd end up actually surrendering the whole thing and getting like $200,000, because what we would do is instead of my option where really it was all gains the first 3 years, a little bit in year 4 and none in year 5, we could say, let's spread the gains out over all 5 years, making a 50, 50, 50, and then 50, 50, 50, 50, and then say like a $200,000 distribution. So that last distribution would be 50,000 of gains and all of the cost base. So doesn't have to be even, could fluctuate. Spouse inheriting qualified annuity would have lifetime option, correct? Yes. Yeah, so a spouse inheriting a qualified annuity is the same thing as a spouse inheriting an IRA. He or she doesn't actually have to take any of those beneficiary options. They could just retitle the IRA to themselves. Said inherited annuities outside of probate also exempt from taxable estate, right? No. So because most annuities are owned by a person, it's going to be owned by them, and so it'll be included in their taxable estate. So good question. All right, so what are our takeaways today? When your clients inherit an annuity, if you're not an expert after the last 55 minutes, 54 minutes, give us a call, check with me, because there are all these options and we can look at different options for you and your clients. And what's the other takeaway? Be nice to Meemaw. Life's too short. Greg and Marcia really just, cutting Mrs. Brady out of their lives doesn't create anything good for them. They also didn't get their share of these annuities. So at the end of the day, be nice to Meemaw, because one day she may name you as a beneficiary of the annuity. Thank you, everybody. And so for anyone who's new and isn't used to all of our webinars through the course of the year, here's a list of some that we're going to do through the rest of the year. 1 hour CFP CEs for all of you to get some of those coveted CEs that we all need throughout the course of the year. A few things other about us. We only work with fee-only advisors. We don't manage money, we help with insurance. And so you do what you do, we do what we do, and we make a great team. We spend a lot of time pre-underwriting clients when they're applying for life insurance or disability insurance, long-term care insurance, to find the best fit for your clients. So when we finally apply for a policy, we're as close to getting them that approval rate as possible. There's a lot of information on our website. Proud sponsors of all of these financial planning groups, and hoping to see some people face to face at the end of the year. Maybe not the beginning of this year, but fingers crossed for the end of the year. We have specialists in life insurance, disability insurance, long-term care insurance, annuities, hybrids, so combination life or long-term life and long-term care policies, or annuity and long-term care policies. And we have a policyholder service team who help you and your clients manage their policies, not just when they get the policies, but years from now if they need to make changes or have any questions. And we have Alice, our online portal for advisors and clients. A lot of good information there, and it's available 24/7. So for anyone who likes to look at clients' insurance policies at 3 a.m., you know what? It's there. I'll be asleep, but it's there. And so I think I answered all the questions. One question: how much are typical annuity expenses charged by insurance companies? I believe the last thing I saw was somewhere between 1 and 1.5%, and that's without any lifetime income riders, a lot of the riders that can be added onto policies. So I hope that helps. And here's a picture of all of us pre-COVID, no masks, close together. And so thank you to everybody for tuning in. I hope you had as much fun as I did. And thank you so much. And I think I will see you all again in May. Thanks, everyone.